The U.S. stock market experienced a dramatic plunge on March 5, 2025, wiping out months of gains. This sudden downturn was a direct response to President Trump's aggressive new tariff policy. The Dow Jones Industrial Average plummeted by a staggering 1.5%, a loss of over 650 points. This marked one of the most significant single-day drops in recent history. The S&P 500, a broader market index, also took a substantial hit, falling by 1.2%. This decline erased all gains made since the 2024 election. While the tech-heavy Nasdaq Composite experienced a less severe decline of 0.4%, the overall sentiment across Wall Street was one of fear and uncertainty. This sell-off signaled a growing concern among investors about the potential for a full-blown trade war. The market's reaction served as a stark warning about the potential economic consequences of protectionist trade policies. The suddenness and severity of the market's decline underscored the fragility of the global economy in the face of political uncertainty. The catalyst for this market turmoil was President Trump's decision to impose sweeping tariffs on imports from Canada, Mexico, and China. These tariffs, which went into effect at midnight on March 4, 2025, represented a significant escalation in Trump's protectionist trade agenda. The tariffs targeted a wide range of goods, including steel, aluminum, and agricultural products, and were met with immediate condemnation from both domestic and international leaders. The tariffs on Canadian and Mexican imports were set at a hefty 25%, while Chinese imports faced a 20% levy, double the previous rate. Trump defended these tariffs as necessary measures to protect American jobs and counter what he deemed unfair trade practices. He argued that these tariffs would force other countries to negotiate more favorable trade deals with the United States. However, many economists and business leaders criticized the tariffs as counterproductive, warning that they would harm American consumers and businesses while doing little to address the underlying causes of the trade deficit. The international response to Trump's tariffs was swift and resolute. Canada retaliated with immediate tariffs on $30 billion worth of U.S. goods, with plans to target an additional $125 billion in the coming weeks. Prime Minister Justin Trudeau denounced the tariffs as completely bogus and very dumb, vowing to protect Canadian interests. China, while taking a more measured approach, announced additional tariffs on U.S. agricultural products, including soybeans and pork. This targeted response was widely seen as a strategic move to pressure Trump while leaving the door open for future negotiations. Mexico also indicated its intention to implement retaliatory tariffs and non-tariff measures. The escalating trade tensions sent shockwaves through the global economy, raising fears of a trade war that could destabilize markets and stifle economic growth. The International Monetary Fund warned that the tariffs could undermine global trade, disrupt supply chains, and lead to higher prices for consumers worldwide. The organization urged all parties to engage in constructive dialogue to resolve their differences and prevent further escalation of the trade dispute. The immediate impact of Trump's tariffs on the U.S. economy remains uncertain. However, early indicators suggest a bleak outlook. Consumer sentiment, a key gauge of economic health, plummeted in February 2025, reflecting growing anxiety over the tariffs and their potential impact on prices. The University of Michigan's Consumer Sentiment Index recorded its biggest monthly decline in nearly 4 years, signaling a loss of confidence in the economic future. This decline in consumer confidence could translate into reduced spending, further dampening economic growth. Adding to the uncertainty, U.S. Treasury yields, a benchmark for borrowing costs, dropped to their lowest levels in months. This decline reflected investors' flight to safer assets amid growing fears of an economic slowdown. The Federal Reserve, tasked with maintaining price stability and full employment, found itself in a precarious position. The escalating trade war and its potential to derail economic growth increased the likelihood of the Fed cutting interest rates to stimulate the economy.